All right, welcome back, everybody. It's great to see so many familiar faces from last year, and just as many new ones as well. Whether you've been following PPR for all 18 years or you're still trying to figure out what we're about, we want to start off by saying thank you for being here. We truly appreciate you spending the evening with us. For those who have been following PPR for a while, you'll see that the firm has evolved meaningfully in recent years in an effort to build out a foundation designed for continued success and sustainability. As part of that evolution, we've redefined the meaning of PPR to better reflect who we are today. Today, PPR stands for purpose, prosperity, and relationships. Our purpose is to promote financial wellness for all stakeholders, including our growing community of investors, the nearly 40 employees you see floating throughout the audience today, and our partners who play a vital role in us executing our on-the-ground strategy. Our mission is to catalyze prosperity, providing our community investors with financial tools, products, and education that empower you to thrive financially and think about life outside of your investment portfolio. And finally, relationships. Relationships are the foundation of everything that we do, from our connections with investors, to our partnership with on-the-ground operators, to our engagement with the communities that we invest in. We're committed to making a lasting impact on everyone who interacts with PPR. Your presence here this evening is a reflection of our ongoing commitment to building with purpose, catalyzing prosperity, and nurturing relationships. Before we hop into the open bar and all the great food that's being prepared outside, we wanted to give you a high-level recap of all that we've done in 2025 and give you the opportunity to hear directly from PPR leadership. Before we hop into the presentation, I want to let everyone up here introduce themselves. My name is Jalen West, and I'm the Senior Marketing Manager here at PPR Capital Management. Chelsea, do you want to take it next?
Yeah, Chelsea DeLuca, Chief Operating Officer.
Steve Meyer, Chief Executive Officer.
Spencer Staples, I'm the Chief Investment Officer.
Perfect. So we'll start off with you, Steve. Since last year's holiday party, we've accomplished a lot. Of all the accomplishments we've had this year, what are the items that you're most proud about?
That's a great question, Jalen. And as the CEO, I get to sit in an enviable position. We've had a very busy and a very good year, so there's a lot of accomplishments, and I don't think I'd be able to summarize them to the T, but I think the ones that stand out, from the top, the tip of the spear, we had a 30% increase in capital raise, which was a record year this year, over a record year last year. But most importantly, we added 180 new investors to our family, which to me just speaks of the trust and foundation we've built over 18 years. And I think that highlights everything we do, because that's what we focus on. Second, Chelsea will probably drive into this a little bit more, but we really spent time building out our asset office and our asset surveillance office this year. And the primary there is to give more information, more transparency to investors. While we're increasing that, we realize we have a way to go. But doing this with the office and adding more tools around it, I think is going to get us there. And hopefully you guys will see definitely a more meaningful transparency and reporting as we go through the year in 26. We also have continued to build out our tech stack. So when I came here, I spent 29 years at a company that was all about technology, and I know what it is to be a technology company. We are a private equity asset management company. So I used to talk to Stuart, head of our technology. I don't want to be a technology, I want to be a tech-enabled company. But I think as time has gone on, and with the advent of AI, we have to be a tech-enabled but tech-driven company too. And we have built quite an impressive array of technology components to help drive the results we do, to monitor, to surveil, and to ultimately provide reporting and transparency. So we continued that build this year, which I think really is going to be beneficial for the future. We've also expanded with the leadership of Spencer, our investment thesis this year. So taking all the strengths we have in building out the NPL business we have over the past 18 years, we've now been able to point that at other opportunities. And I think that diversification, which whoever was here last year, remember that's a big thing for me, because I think that's how we continue on our brand promise long-term for our investors, for all of you in the room and those who couldn't make it. And I think that building out is going to be, and that broadening will just really help us continue on that sustainability path. And lastly, I'd say, we've gotten a number of awards over the years, and awards are nice, but there's ones that stand out. And this year, I'm really proud of the team. We were ranked #1 fastest growing company in the Philadelphia region by the Philadelphia Business Journal. So, and listen, while we're very proud of that internally, that award is shared with all of you, our investors, because without you, we would not be able to do it. So there's a number of awards, numbers, accomplishments, But in my heart, at 60,000 feet, what I am most proud of, our team. They show up every day and execute at a high level for the benefit of our investors. And I'm super proud that we do that, not only measure the importance of the financial returns, but equally on the positive impact we have in the communities and worthy causes that we support. And to me, when you have a company that does that, you are a purpose-driven vision company, and our employees execute on that every day. And I'm just super proud of the team for that.
Yeah, very much so. You can feel the passion and the purpose in the office, and it's great to be a part of the team. So Spencer, I want to kick it over to you next. As CIO of now a $1.4 billion platform, what are the core messages you want investors to take away from this presentation this evening?
Boy, I tell you, Jill, and thank you. There's so many things I'd like to tell the investors, but I think the first thing I want to say is it's so nice to see all of you here tonight. I remember just a year ago, we were having this event in the kitchen. It was sort of like kitchen table mat.
The kitchen fireside.
And now we've upgraded to the cafeteria. So I'd like to think we're making some progress. I thought a lot about my main message to you tonight, and I thought, what I would really like to portray is what you would like to know, I think, about how our portfolio is positioned and how that benefits to you, and some of the core building blocks around our portfolio. So I'm going to ask you to maybe just get a little nerdy with me and just work on a couple charts up here on the monitor, because I do sometimes think that pictures, tell the story better, and I think this might be the case. If I could draw your attention to the graph on the right, now on the left, excuse me. Now for some of you it's probably difficult to see. But what I'm trying to show here is that, first of all, on the vertical axis you have return. And on the horizontal you have volatility or essentially risk. And if you look at the three bottom pie charts, those represent different kind of portfolio weightings that a typical investor like you might have. For example, that bottom left pie chart is 60% bonds and 40% stocks. Now, probably some of you have portfolios like that. And if you go to the far end, you'll see that the pie chart on the right, that has 80% equities, or in other words, stocks, and only 20% bonds, and everything in between. Now, the big takeaway from this graph for you tonight, I hope, is that you see that in the three pie charts up and to the left, you have a slice that's called alternatives. And when you add alternatives to a portfolio of various weights, as we just described, you're almost inevitably going to see a better return risk relationship. Can you see that up there, how the pie charts with the alternatives have the same or a little bit more return, but they're over to the left and they have less risk? So my point to you on this first chart is it's almost incumbent upon investors to add alternatives. Who wouldn't want to have a portfolio that has maybe a little bit more return and less risk? So alternatives is really an essential requirement for any sort of sophisticated portfolio, I would say. Let's go to step 2. Again, bear with me with the chart. Over on the right, you have some colored dots and some names next to it, and you probably can't see it here in the cafeteria. But these are all the asset classes that are available in alternatives. You have things like private equity and infrastructure and so on and so forth. The point about this chart is you can see the 60-40 portfolio over there in blue and green, a typical portfolio of our investors perhaps. As you move to the left, you get more diversification. So to get the biggest bang for your buck for adding alternatives to your portfolio, you want to be choosing asset classes to the left. And one of the main asset classes to the left that gives you the most amount of diversification is what? You see it there, real estate. So you have a portfolio. Step 1, you know you need to add alternatives. Your next question is, what asset class do I add? Real estate is one that gives you a lot of diversification, more than other asset classes. Now let's go on to the final and third step. This is the software that we use. It's specifically designed for real estate, but I won't go too much into that. But what I want to show you is this. You see the S&P 500 there and the 5-year bond, and you can have any combination of assets in there. You can see that by adding real estate, PPR's portfolio, you're benefiting from diversification, and you're getting better return and less risk. Now this chart has some assumptions in it that I won't go into right now, but suffice it to say that real estate, the main asset in our RF portfolio, and in particular, residential real estate, is the one where we're focusing on the most. Now, let me just finish by saying in residential real estate, there's a number of different subclasses as well. You could have storage. You could maybe have logistics, or maybe even in office in real estate. But PPR chooses to be in residential real estate for a reason, because there's a shortage of residential real estate nationwide. You've all heard about the affordability crisis. We're about short 600,000 multifamily units nationwide. Depending on what research you read, we're short about 2 to 4 million single family homes in this country. And it's very hard to catch up. Well, as someone who's running your portfolio, I want to have a following wind at my back. And if there's a shortage of supply of the assets that we're investing in, that's just all that more interesting to me.
Yeah, thank you, Spencer. And it sounds like having alternatives in your portfolio is a vital part of having a sustainable portfolio. Having residential real estate in there bolsters it even a little more, which is great. So obviously, behind managing the $1.4 billion in assets, there's a lot of operations that go into it. Chelsea, what operational upgrades have we made this year that have improved our execution and allow us to protect investor capital as we continue to scale the business?
Yeah, one of the main areas that we wanted to focus on this year was further enhancing our surveillance processes. It's a main area for us, and we believe it's where we add the most value to you, the investors. And our surveillance process is really just how we monitor and intervene if investments happen to fall off track. And it's where we can use our 18 plus years of experience, taking everything that we've learned to jump in and help our sponsors out and bring new ideas to the table to ensure that our investments perform in accordance with our expectations. So one of the things that we did this year was we implemented some technology to help support us in that regard. So one of the areas was a new asset management platform specifically for our build-to-rent and multifamily portfolios. And this system actually pulls in data from all of the different property management systems that we work with. Because again, we have properties all over the country and different property managers. So it pulls all of that information into one system, and we can look at our portfolio in a more normalized way. Things like occupancy, rent growth, budgets, actuals compared to our initial expectations. And the key to that is that we're getting that information real time. And this is, a huge deal for us because we believe with our surveillance, the faster we're able to jump in and intervene and spot a problem, the faster we're able to get things back on track. And again, for investors, that is the value, one of the biggest values that we're doing is we are constantly watching this portfolio, and things always go wrong in life, right? But you want to jump in and you want to deal with it. And, I think we've seen a lot of success when catching things early and actually finding opportunities to lean into and actually enhance our projected returns. So we're really excited about that system, and I think it will also, to Steve's point, as we continue to level up and expand our transparency with investors, it's going to really help us do that. And so we're excited to see and share more information about that in the coming months. Another thing that we did is we implemented a tool that we use in many different ways. It is a tool that uses GPS location information, and it's powered by artificial intelligence. And that tool we use, one, to help us select the geographies that we are investing in. So we are actually able to use that system and look at migration trends, again, in much more real time as compared to traditional sources. And so we are using that to say, here we want to invest in this specific state, this specific location. So we use it on the macro level, and then we also use it to look at individual properties and make sure that that individual property or multifamily location or build to rent is in a desirable location. So traffic patterns and commute times and all of that, we're looking at. And then third, we use it to help actually add value to our sponsors. So we are using that tool to actually provide some strategy on lease ups, for example, and maybe where they could better target potential future occupants. Another thing that we did is we've actually increased the amount of on-site site visits that we're doing for all of our properties. So again, we have properties all across the country, but and we lean on our sponsors and our property managers to manage a lot of the day-to-day operations. But we want to get our boots on the ground and get our eyes on that property and meet the team on a regular basis. So in Q3, we actually visited 9 different properties, and it's another way that we're trying to just stay on top and have as much information about the properties as possible. So all of these things that we're doing, again, we're trying to make sure that when we, again, from a macro perspective, we are looking at the portfolio, the investments, and we're making the right decisions on the geographies. And once we acquire those assets, we want to make sure that we have our eyes on them, and we're making sure that we course correct if anything happens to fall off track.
It sounds like the big theme there is really staying on top of the assets and catching problems before they balloon.
Yeah.
Nipping that in the bud as soon as possible. And the technology piece is interesting because you look at most firms our size and look under the hood, and have nearly as much technology going on. And we really latched onto that, and we're leveraging that in a positive way.
Yeah.
So Steve, I want to kick it over to you next. While capital raise in 2025 has slowed for most firms, PPR has continued to grow in commitments. What would you say has enabled that growth this past year, and how does that create opportunities for all the investors we have in the room this evening?
Okay, great question, Jalen. I'd say first and foremost, relationships, the R in PPR. So we're proud to say that most of our growth, while we've expanded out, affinity groups we go after, certain channels we go after, most of the growth we've gotten this year has come from the investor pool, all of you and the folks who couldn't be here tonight, continue to reinvest with us, introduce us to friends and family and partners of theirs, and really expanding out that PPR family. So that foundation of trust is something we hold in very high regard. That's the number one thing we want to protect because that's the core to our growth. Second, I'd say it's a focus issue. So many firms our size have a decision to make. There are very few that have grown to the level we have through accredited investors. And I still have and talk to many, many large firms like Ares Capital Management, one of the largest private equity firms in the world. Their CEO wants to find a way to come down, as many of them do, to attack the wealth channel or retail investor, because they all took capital from institutions, pension funds, sovereign wealth funds. We have been approached over the year, I have been approached this year from institutions. They have a high degree of interest in investing in a firm like PPR and investing in our products. I refuse to do that. Now, Bill was actually at a conference this week where he was told, probably in so many words, my approach is probably stupid, because if someone's willing to give you capital, take it. I fundamentally disagree with that because of this. The moment we start taking institutional capital, we cannot focus on the needs of our current investors and the retail accredited, where I believe is the highest level of growth over the next 10 years. It's a harder path, but was it Socrates who say anything worthwhile is difficult? And I think it would be somewhat of a sellout for us to go to a large pension fund or sovereign wealth fund, and they have a tendency to change your firm and change your culture. So I think that intense focus on retail accredited investor really kind of marks who we are and what we're going to do. And if you look at the opportunity going forward, market research and industry, there's about $14 trillion that's now planned to come into the alternative markets that Spencer highlighted over the next 10 years. 7 trillion of that is going to come from retail accredited investors. So I look at it and say, that's the opportunity we want. I don't care about the full 14. I never want to be the firm that tries to focus on the full 14. I want to focus on the 7. I want to focus on what's close to our knitting. And I think that strong foundation, that conviction, that focus really has helped us grow assets. And the last piece I'd say is when I first came here and we talked about our strategy of PPR Next, ultimately we want to become a platform. We want to help be a voice of alternatives for retail accredited investors. Not just what we do today, but also what we plan to do in the future. And to me, part of that is we have this great platform to provide not only opportunities and investment opportunities, but education. The number one reason why the normal retail accredited investor does not invest in alternatives, they don't understand it. They don't trust their wealth advisor who does not understand it. And I think the best way to combat that is through education. And I think you're going to start to see us take a meaningful leap into how can we provide more information and education around this.
Yeah, that education piece makes me excited for the growth of the firm, because as someone who's spoken with hundreds of our investors at this point, some of them in the beginning they're a little murky, don't understand it, but once they understand it, they're ready to hop in, they're excited to hop in. So I'm excited for that piece there. So Chelsea, our internal theme for this year was level up. Trying to find ways to level up the business in every area possible. Which of the level up initiatives have had the biggest impact on the investor experience and the overall fund performance?
Yeah, one of the things I'm really excited about is we have launched the PPR Prosperity Report. And huge shout out to you, Jalen. I know that was your brainchild, and it's definitely a labor of love. That report spans the whole company. So within it, and a lot of you might have seen it, and is a financial review. It touches on new technology, all of our different verticals, staffing changes, and new hires. And so it really touches all areas of the company, and we're trying to just share a little bit more behind the scenes of what's happening and what's going on in the fund. And actually, the team made a huge push. And on your tables and around, you'll see QR codes around, and we have our new prosperity report fresh off the hot off the presses and ready. So definitely take a look at that. We're really proud of it. We've received great feedback about the report and that increased communication. We're always looking for additional feedback, so definitely reach out to the investor relations team if there's something that you want to see that you're not seeing. We'll definitely hear everyone out and try to incorporate more. So we're really excited about that, and our continued push to be more transparent is something that we're continuing to work on and really lean into. And another thing that I'm really excited about is, we've made several new hires this year, and all of those, new hires, a lot of them were in the investor relations team, which is obviously meant to help serve our investors, and our asset management team. And one of the other new hires that we have recently brought on board is Heather Crowell, our new Chief Marketing Officer. So really excited to welcome her on board. And really the goal with Heather is a couple of things. One, she's going to really help champion that push to increase our transparency and enhance communication to our investors and really seek feedback from investors and try to figure out how we can better deliver on those things. And then we also are going to be touching upon, what Steve just said, which is trying to leverage our over 18 years of experience in this space. We are in non-performing loans, build to rent, multifamily, car washes. So in the alternative space, we have quite, I feel a lot of experience. And so we want to share more and more of that with investors and, share some of the hard lessons that we've learned and maybe some of the tips and things to just add more value to the investors.
Yeah, and it's great because you can already see the lift that Heather has provided us, allowing us to pull off that story that we've built over the past 18 years.
Yeah.
So I'm excited to communicate that further with our investors. So Spencer, as we continue to grow the firm and move into asset classes beyond just notes, as an award-winning economist and contributor to the Bloomberg Consensus, can you walk us through the top-down economic analysis that we do on assets, and then walk through the due diligence process as well?
Sure, my pleasure. Now, you said a couple things that probably maybe need a little bit of explaining. One is, what is the Bloomberg Consensus? So PPR is one of 40 or 50 economist groups around the country and around the world that contribute to what's called the Wall Street expectation for Bloomberg, Dow Jones Newswires, and the Wall Street Journal. So when you hear, for example, in the news that the hiring number came out 100,000 more jobs than Wall Street expected, then we'd be part of that Wall Street consensus. And probably if it was 100,000 jobs difference, probably have a little bit of egg on our face that day as well. But I just wanted to let you know that that's what Jalen's referring to with the Bloomberg Consensus. What I would say about our investment process is that I'm essentially using with our team the same kind of rigor that I use to create forecasting at the very highest standard. I want you to know that the process is the same. We basically operate on 4 levels. One of them is, as Steve alluded to earlier, we start with our investment thesis. I call it sort of the investment management Bible, and we seek to follow it faithfully. And we operate from 3 databases that informs our real estate decisions. Chelsea also alluded to the fact that we have GPS software We have up-to-date migration information. When we're looking for our location score, which is what we develop when we're thinking about buying a property, is looking at what property maximizes commute times, how close it is to amenities for people who would likely be occupying our properties, and so on and so forth. And finally, you saw a little bit in that last slide that I showed you, but we have very specific software designed for real estate, and we are constantly looking at our portfolio to make sure that the changes that we make, the outcomes that we're hoping for, are the ones that are going to maximize the return at a given level of risk. In other words, to try to optimize our residential real estate portfolio as much as we can for your benefit.
And if I can just jump in, Spencer, one thing I'd add, we're throwing a lot at you with what we do, and it's hard to kind of visualize it. But let me put it in simplest terms. I'm typically the guy with the crowns. I have a lot more smarter people around me than me. But we really are edge. We have this unique way of taking the macroeconomic analysis, which Spencer does, and combine it with the micro property level investment level. You do not see the chassis we have from technology, the approach. You don't see it at a firm our size. You see it at a firm $20 billion. You see it at a firm like Ares. That is a unique characteristic of us. And it separates, I think, us from the pack of many other folks that are just focused on real estate investing. Many of them just do microanalysis. Let me look at this one syndicated multifamily, and I'm going to make my decision with no regard to where macro is coming. I know a lot of people in this room have invested in multifamilies years ago. Things didn't work out so good. That's why people said, this is a great property. Nothing can go wrong. And they didn't do the macro combination on top of that. We don't do that. Spencer doesn't allow us to do that. And everything we do, and we'll get into a little bit, I know we have rate changes to talk about. Everything we do ahead of the course, because we see it coming because of this. Are we always right? No, no one's always right. But I'll tell you our history of point, we're right a lot of the time. Spencer has been right a lot of the time.
Spencer's team has been right a lot.
You can take the credit.
That was assumed.
All right, great. All right, so Steve, as we look at reviewing our offerings and looking to diversify the firm, what can investors expect from us in terms of new offerings, expanded access, and the return potential associated with those?
Yeah, so I think probably we should start, before we talk about where possibly future investments could be, where we are with our current investments. So let me start with one near and dear, the Opportunity Fund, our car wash fund. So that fund, I believe, is on it's ready for its next level of growth. Of the 6 sites we have in that Opportunity Fund, 2 are up and operational. Another 2 by mid-year next year or sooner will be up and operational, and the remaining 2 by the end of next year. Within 26, we expect to be fully operational. We also are looking at ways to enhance the return to investors on a number of ways. So teaser alert, I cannot go into detail. There will be more coming because we're in the middle of finalizing deals. But we are looking for a way to be additive to our investors, current and future in that fund, by doing things like, say, us adding another fully operating, well-performing car wash site into the fund, which is cash flowing as of today, a lot of experience behind it, and one of the top Tommy sites in this region. Can't say anything more.
I was like,
I know, I felt it. Second, we are also looking at ways for us to potentially find a better way to get, change the economics a little bit and get higher splits to our investors. And we're looking to do that all in tandem over the next month or so. So I think that fund it's been doing well. It's now ready to hit its next level of growth. Then let's look at our core foundational, what we call our income fund. So I think the big news there is, I'm sure everybody in this room knows, and the investors that could not make it, we've recently announced a rate change. I know some people view that as negative. That is positive, and let me tell you why it's positive. We are doing this before things start to get tighter. Right now, we love the NPL market. We're not abandoning the NPL market. It will still, as I've always said, be a core foundation of what we do. But the pure fact of the matter is that market right now, and through Spencer and his team, we've been able to see this coming and get ready for it. It is highly competitive. The prices are way up and the spreads are tightening. So on average, you see these things in the market going for 7. Our fund pays 12. That is a mismatch. Now, we've built plenty of room. We have things that are securitizing and selling, so we have plenty of padding around it. But long-term sustainability, as I said last year, is our key focus. So for the benefit of the fund, we are in a cycle where this now has to go down. We still believe, even with reduced rates, we're still going to pay at the top of the market because of the way we select, buy, and hold those assets. And also because we diversified the fund. It's not just NPLs, it's also multi-BTR. So that diversification, outside of that, if we didn't, it would be like us having 100% in one stock. Not a good idea. We've diversified to build for the long-term sustainability. Lastly, where we're heading. So everything we've built, everything you've heard about Spencer, this macro, micro, we've built and perfected around NPLs. And now that chassis, we're able to point at other investments. So we are looking to span out to provide more opportunities, risk-adjusted returns, different opportunity products going into 26 that we can offer to investors. But the two things I would sum it up, everything that drives our investment is sustainability and diversification. And most of the sustainability will come from diversification. I said this last year, our job is not, and I do not focus on giving you a return this year. I don't focus on giving you a return over the next 2 years. I focus on giving you all, our investors, return for the next 10, 20 years. That's how we're built, that's how we focus, that's how we make investments.
Yeah, thank you guys. There's obviously only so much that we can share in a half an hour, and we want to give you guys some time to ask questions. So I want to open up the floor now to any questions from the audience or from the investors in the room. Got one right here?
I got one. You got 1.4 of AUM. How much is your leverage? So what's your actual equity?
Yes. We tend to operate at relatively low leverage. We're roughly, on average, running between 2.5% times. So you can do the math right there and see that we're roughly around 500 million of equity. We can lever down in times where we feel like it's appropriate, if maybe risk is increasing in a certain asset class or on a macro level. And likewise, we can lever up a little bit. But generally speaking, we operate with what I would call fairly low leverage, 2.5 times across residential collateralized real estate.
Yeah, thank you, sir. Next question?
Cheryl Beth Kuklar. First of all, I wanted to say thank you so much for your transparency and for being willing to open up the kimono a bit and tell us a little bit about your process, and congratulations on the awards and the challenges that you've been able to overcome this last year. Just wondering if you're willing to open up the kimono a tiny bit more around the strategic diversification. Having been a long-time investor with you since, I can't even remember, 10 years now, watching you grow, curious about what's coming down the pike. What should I be aware of as an investor looking to that?
No, thanks, Cheryl. That's a great question. We touched upon it in some of our answers, so maybe I'll address it this way. So listen, when I first came here, we were viewed at, and I would hear it when I talked to investors, you're the note fund, you're the note guys, you're the note people. I don't think people really view us as the note people. That's the investment vehicle. They view us as the income people. That, if you look at 60+% of our investors, of you all, that's why you come to us. 18 years, consistent return, no frozen redemptions, no missed payments. You get, whether you're compounding or paying out. To me, that leverages into what I keep saying which is my holy guiding light, sustainability and diversity. And I knew, I was with Dave when I came up with the idea for the car wash fund. And I know there's probably some people in the audience today that are like, who is this crackpot? What is he doing? It was all about spreading out opportunity, taking the chassis we had and pointing it at more true private equity that had grounding in real estate, but adding that diversity level. So while we're looking at other specific asset classes and products, I'd say right now we don't have anything that we're going to come out new with in the next month or two. I would say in 26 you'll probably see us lean into a potential different structure with a different risk-adjusted return, but again, based in real estate. I think we have this core of real estate, and as Spencer pointed out, that's a great foundation from diversification, asset allocation, and risk-adjusted return.
Excuse me. Oh, yeah, you can hear me. Thank you for hosting.
Sure.
20 months an investor, first time
Thank
here.
you.
Yeah, of course. No, I've been very happy. The affordability crisis is something that should be on everybody's mind right now, obviously.
It is.
The spreads between what people need to make and what they can afford is completely out of whack. And so if you're gearing towards the residential real estate market, as it sounds like you guys are, how much does that factor into your methodology? And then in the future, in the entire portfolio, how much of that, in 5 years, let's say, how much of that do you want to be in residential versus multifamily versus whatever else?
I'll take first part of it. I'll give you an example of, we've been thinking about the affordability crisis for a long time. You may have noticed that over a year ago, we started to move into BTR, which is build to rent. And what build to rent does is it's a single family community as opposed to an apartment building. And the supply of BTR, single family rentals compared to actually multifamily rentals is relatively low. So there's a lot of room for it to run. We realized that demographically, there were going to be people in their 30s and 40s, our key area of rental age, that needed to transition out of apartment living. And they were having children, pets, their life was moving on, but with the affordability crisis, they could not make the leap up to the higher mortgage payment. Well, BTR is a natural place to be and for that expansion to happen. And so we feel like that's just one good example of how we are looking at the demographics, we're looking at the economy, and we're trying to provide needs where they arise.
Yeah, and really quickly to add on as well, some of you may have seen that we have recently launched the PPR Prosperity Foundation. And that's something that's our corporate foundation, and the kind of mission and main goal of that is to really try to in our own way, in our own small way in the country, try to address and help out in that affordable housing crisis, specifically kind of starting with the veteran community. So we're really trying to take a push and use the skill sets that we built and the connections that we built behind the scenes, and just one of the P's in PPR's purpose is really lean into that. And try to influence and make a difference in some way as well.
And the second part, where do you see the future in the residential space for PPR?
Yeah, sure, happy to answer that. I mentioned earlier that one of the reasons that we're in residential real estate is that we feel like we have a following wind, that we have a competitive edge in that area. And we just do not see for the next 5 years the ability to address successfully through legislatively or otherwise the shortage in both multifamily and in single family. At some point, the demographics are going to change. We have declining population, we have an aging older population, and you're going to see some change after, let's say, around 5 years, 2030. That dearth of housing is going to start to dissipate. And so we will continue to be in that space up for the next 2 or 3 years, and then we will be thinking about that time about making some adjustments, but not any time in the short term because we expect it to persist.
Thank you guys for hosting. My name is Dave Hathaway. My biggest question, and I'm curious from all three perspectives, from ops, from CEO, from chief investment advisor or officer. What is your biggest worry and what keeps you up at night?
Why don't you go first, Schultz?
I have a lot of worries.
I was going to say everything, but
I have a list. I'm known to be a worrier, and I think that's just part of operations in general, is that we get to, especially myself, get called in when there's a problem or something needs to be, addressed. I think that, one of the biggest things for me is just making sure that we are kind of staying ahead. Technology, especially artificial intelligence, is advancing at such a pace that I worry that some of the technology that we're implementing will kind of quickly be irrelevant. So we're spending all this time and effort and training and putting all this, infrastructure in place. And, is some new kind of technology innovation going to come out where, that is not relevant anymore? And so we really try to stay on top of that. And, Stuart, our, head of IT, as well as myself and Steve, we constantly are monitoring kind of what's happening in our space and in technology in general, and we're trying to stay one step ahead, and especially with artificial intelligence, leverage it in a way that we are being proactive, and it's going to continue to add value. But yeah, that's definitely one of the things that keeps me up at night.
Good, Spence.
I think I'd probably just say two things. Regarding worry, I wouldn't use that word. I would say that we are determined to. We feel like we're in the right. We're positioned correctly in the alternative space, just as some of the things I mentioned earlier. And we're motivated to see the outcomes happen. That's what I think it is. Rather than worry, I would say it's more like determination and motivation. For instance, the execution on our portfolio is very important. We can buy the right property at the right time in the right location, but if you don't execute on it, that's a problem. If you look where a lot of our tech investment has gone to, it's been in the operations to make sure that we execute on the portfolio correctly. So really, just in sum, I would say we're quietly determined. We know that we're stewards of your funds. We're quietly determined to make sure that we get the outcomes that we expect, and we're motivated to do it. And yeah, sure, there's a little worry, but it's mostly the former.
Yeah, and maybe I'll recap. Spencer, I thought he was going down a different path. I wouldn't say worry. I think as I've aged, I used to worry a lot, and I had a mentor once who said, and I would explain to him, I'm worried about this. He said, so you're admiring the problem. And I got very upset at him, but at the end, he won the battle. I'm like, you're right, I'm admiring the problem. And I think what I've trained myself to do, and someone who has raging ADHD, I have a lot on my mind all the time. And I do take very seriously the trust and commitment we have to you, our investors. The fact that many of you have your retirement money and count on the income, I take that extremely seriously. I take very seriously the lives and livelihood of the PPR employees, and I take very seriously, the impact to our communities and our stakeholders. Where I choose to focus, it's not really worry, it's trying to look around corners. That's where I spend a lot of my thinking time. I'm very focused on things that could disrupt us, things that could disrupt the market. And I've got a great team here at PPR that think very similarly. And we are constantly wondering what technology could disrupt us. Could tokenization disrupt the industry? Something that our CIO brought up that at first glance are like, not sure. But the more you look at it, that's a real possibility. So I tend to spend more of my time looking out to say, what could disrupt us and how do we avoid that?
Just to follow up for Steve in 1 second on, because he brought up the point, and I didn't know if it was going to become a question tonight, but digitalization is coming to financial markets. It's going to have a large impact. Rest assured, PPR is working on that, and we're planning for the future, and we understand the implications of it. So it is in our purview at this point.
I think we have time for one more question.
I just have a quick one for those of us that don't see too well from a distance. Are those slides available?
Yeah, this is all recorded. We'll send out the recording in the following weeks. Yep. Cool. All right, well, thank you guys. We appreciate you all being here. Yeah, we'll be around the rest of the night. If anyone has questions, feel free to talk to any of the PPR team members to ask some questions. We have 2 open bars out there, so feel free to shuffle over to the right. That's when I know it's going to get crowded pretty quick. So, thank you guys.